Hi everyone, my name is Al O'Grady and I am the founder of 2%Gold.com and I am a swing trader. My goal? To double my money on the stock market virtually risk-free every year. Now, what's a swing trader and how do I do it? Well, let's find out. As I say, I am a swing trader. I am not a day trader. What's the difference? Well, a day trader by true definition does not own a share at the beginning of the day nor at the end of a day. A day trader by true definition buys and sells his or her shares intraday. Stock market opens up at 9:30. They probably bought their very first position at 9:30:01. And then they probably hold it maybe till about 11 o'clock thereabouts or whenever the time is right. They exit their position. They might enter into another position at 11 o'clock or noon hour, depending on how the morning trading activity is going, but they'll certainly exit by 3 o'clock so that by 4 o'clock when the markets close, they do not hold a position. That's the true definition of a day trader. A swing trader, which I am, same thing but a longer time horizon. We're going to hold our position anywhere from 3 days to 3 months. Now, myself personally, my sweet spot is 1 week. I'm usually holding most of my shares just for a week. If it's 2 weeks or more, it's only because the stock is climbing and I'm holding on to it. But by and large, I'm holding my position for about a week. Now, why swing trading as opposed to day trading? Basically, my personality makeup. I don't want to be in front of a computer terminal 6, 7, 8 hours a day. No, thank you. Could I be in front of a computer terminal for 1 hour, an hour and a half? Yeah, sure. I can certainly do my research, make my trades, but I want to go out and have my life. I want to read a book, play with my grandkids, watch a ball game, play poker, go to a movie, just enjoy life. So. Being a day trader, I'm not interested in being in front of a computer screen all day long, but certainly for an hour a day or so, doing my research and watching the charts, I can certainly do that. That's certainly part of my personality profile. Now, it's very important in life that no matter what you're doing, to be successful, you have to have goals. And your goals, I'm sure you've heard of the SMART acronym: specific, measurable, attainable, relevant, timely. Your goals have to fit that profile in order to be successful. Now, you may have read Chicken Soup for the Soul. It was a book written by Jack Canfield. And there's a quote in that book that has always resonated with me. It simply goes like this: vague goals produces vague results. Let me say that again. Vague goals produces vague results. I want a specific goal with a specific result. I want to double my money. That's a 100% rate of return. A very, very lofty goal, but if you break it down into smaller bite-sized pieces, it can be achieved. And what I'm trying to do is 2% per week. So if I can get 2% per week, week in and week out, over 52 weeks, that's more than 100% rate of return. I've doubled my money. That's my goal. That's what I'm trying to accomplish. Now, if you've been bouncing around on YouTube, looking at other YouTube videos and seeing other people's swing trading tactics, I am not here to trash anybody else's system. If they have a different system and they're making money, God bless them. I hope they make as much money as they can. I am not here to say that I am perfect. I am not. There are times when you will lose. However, when you play the percentages, there are certainly a lot more pros than cons, and this system can be very, very effective. If you've tried those systems, those are other people's systems, and it's not working for you, for whatever reason, it just doesn't fit your profile, what have you, take a look at what I have to offer. Maybe this does work for you. So I have 10 rules, and let's get started with rule number 1. Only buy companies on the S&P 500. Okay, the United States is the #1 economy in the world, bar none. And the S&P 500 are the top 500 companies in the best economy in the world. Okay, these are solid companies. You know these companies: Home Depot, Pfizer, Johnson & Johnson, IBM, Merck. I can go on. These, as I said, these are sound companies making real products, real profits. They have sound fundamentals and sound management. So you have certainly some security when you're buying these companies. They are not fly-by-night organizations, okay? The other thing too, when you're looking at these companies, they are heavily traded every day on the New York Stock Exchange. Each one of these companies, not uncommon, their daily trading volume is in excess of 1 million shares. That's important because it's very easy to get in. Your order will get exercised almost immediately once you press that button. And more importantly, it's also very easy to get out. So rule number 1, only buy companies on the S&P 500. Rule number 2, RSI. Okay, the very first thing that I look at as far as the charts are concerned when I'm looking at a company and their stock, I'm looking at something called the Relative Strength Index, or RSI for short. Now, before we go any further, the website that I go to when I'm looking at my charts, it's stockcharts.com. You can go to any site that you like, so long as they have the tools that I'm about to show you. It doesn't really matter to me. I've been using stock charts for years. It's very comprehensive, lots of information. It's just a great site in my humble opinion. So that's the one that I default to. Now, when I'm at stockcharts.com and I'm looking at a company, look at that relative strength index. And it's a great indicator because it shows if that stock is overbought or oversold. And you want to buy a stock that's, if you want to buy low. I mean, how much harder is it to comprehend that? Now, the RSI, it measures speed and magnitude of a stock to determine if it is actually oversold or overbought. It was invented in 1978 by a guy by the name of J. Wells Wilder, and he actually produced this chart. It's a line chart. The line fluctuates between 0 and 100. If it's 70 and above, it's overbought. If it's 30 and below, it's oversold. So as I say, when you want to buy a stock, buy low. But some people, it's a very, very simple concept. People don't do that for whatever reason. So when you're looking at the RSI, look for stocks that are oversold in that 30 and below range. And then you want to see them coming out of that. You want to see them penetrating that 30 line, that 30 threshold. So that's rule number 2. Look for the relative strength index to see if it's in oversold conditions. Let's go to our next step. Rule number 3, 50-day moving average and 200-day average. After identifying a short-term dip in the stock, you want to make sure that the overall long term is bullish. Always go with the trend. The trend is your friend. Don't swim upstream. Have the wind at your back. I don't know how many different cliches I can throw at you right now, but you want, as I say, you want to go with the overall trend. Now, a quick way to see the longer term trend is by using a 50-day and 200-day moving averages. When buying, always make sure that the 50-day moving average is above the 200-day moving average. As I said, this is showing that in the longer term that it's giving you a bullish signal, and that's exactly what you want. If you found a stock where the RSI is oversold, it's below 30, but that 50-day moving average is below the 200-day average, move on. You don't want this because that's a bearish signal. You don't want that. Move on. So you want to have as many signals as positive as much as possible going forward. So if you found a company where the RSI is below 30 and coming out, and that 50-day moving average is above the 200-day moving average, this is a fantastic starting point. This is exactly what you want. It's a great 1-2 punch. Put that stock on your short list. Watch it daily because this is exactly what you want. You're not there yet, but this is a great starting point. So, rule number 3, always make sure that when you're buying a stock, that 50-day moving average is above the 200-day moving average. Now, let's go on to our next point. So you found your stock, you've got that 1-2 punch, you found something that's been oversold because of the RSI indicator, it's oversold and it's now breaking that 30 threshold, and also that 50-day, 200-day moving average, long-term bullish, that 50-day average is above the 200-day average, and you're ready to pull the trigger, but not just yet. Now, my favorite technical indicator, it's something called the stochastic oscillator. It's a momentum indicator. It's basically two lines. It's a line chart, range between 0 and 100. It's similar to the RSI, except overbought is 80 and above, oversold is 20 and below. It has two lines. The first line, the primary line, it's really a percentage of the closing price in relation to the highs and lows over the last 14 days. The secondary line is really nothing more than a 3-day average of the primary line. Now, the stochastic oscillator, it's been around a lot longer than the RSI. It was developed in the 1950s by a guy by the name of George Lane. And Lane, he was the developer. He says that the oscillator does not follow price or volume, but instead follows speed and momentum. And he believed that speed and momentum change before the price does. And this makes it a great signal to get in front of that price movement. So what you're trying to do is you're looking for the oscillator to be in oversold territory. So you want it below 20, and then you want it coming out of that 20. You want it penetrating. That is the perfect time. So now you're ready to pull the trigger, but not just yet. Before you do that, you want two more confirming signals, and we're going to talk about those right now. Rule number 5, confirmation point 1 on balance volume. Before you buy, you want to have as many confirmation signals as you can. I have 2 further confirmation signals, and this is the very first one. It's called on balance volume, okay? And you want to be looking at that chart. It's a momentum indicator using volume to anticipate price changes, okay? Now, here's how it works. If the stock price goes up on that day, whatever the volume is on that day, that number is added to a total, okay? If the stock price goes down for that particular day, well, whatever volume, number of shares traded, is subtracted from the running total. So let me give an example. The stock goes up. It doesn't matter how much it goes up. Let's just say it goes up a buck. It could go up a penny. It doesn't matter. But it goes up. And there were 1 million shares traded on that day. Okay, so that 1 million is added to a running total. If it goes up the second day, maybe it goes up $2, and the volume was 2 million. So now you add 2 million to the 1 million, so your running total is now 3 million. And then let's say day 3, the stock goes down, it goes down 50 cents, but there are only 500,000 shares traded. Well, then that is subtracted from the running total, and then that running total is now 2,500,000. Now, the actual number is immaterial. What you're looking for is the trend. Before you buy, use the on-balance volume as a confirming signal. What you want to see with on-balance volume is either an uptrend or at least an uptick for the day. So, confirmation point number 1, take a look at on-balance volume to confirm that it's moving in an upwards direction. Let's look at our second confirming point. Rule number 6, confirmation point number 2, the MACD. The MACD is an acronym. It stands for Moving Average Convergence Divergence. Okay? You have 2 lines. They're really nothing more than exponential moving averages of the stock price. The black line, much more volatile, much faster moving average, and has much more swings. The red line, much slower, much smoother. It's that black line that we're really interested in. The MACD is uncanny for picking the peaks and the troughs of the stock price. Go on any chart. Just look at the MACD, and you'll see that relationship, that one-to-one relationship. When a stock price peaks, so does the MACD. When the stock price bottoms, so does the MACD. And you want to use the MACD as your confirmation point, okay? So your confirmation signal when you're buying a stock is that you want to watch that black line. You want it trending up. It doesn't matter if it's been trending constantly or it's an established upward trend. Even if it's just a minuscule, that's okay, because quite often it's coming right out of that trough, and you're using this as a confirmation point. So at the end of the day, you want the MACD, that black line, as your second confirmation point. You want it going upwards, and it doesn't matter by how much, just so long as it's moving up. Okay, so I've talked about all the different signals that I use for buying a stock. Let's take a step back, let's take a deep breath, and let's just do a quick review, shall we? So you're looking just at companies that are on the S&P 500. You're looking at companies that on the RSI that are in oversold territory, so below 30, and are now penetrating 30 and coming above. Then you're looking at the 50-day, 200-day moving average. You want to make sure that the 50-day average is above the 200-day moving average. You want to look at the stochastic oscillator. You want it below 20, also in oversold territory, and now coming out of that, so penetrating above 20. And then you want confirmation from the on-balance volume. You want it in an uptick or an uptrend. And lastly, you want that MACD as your second confirmation point. You want that black line on the MACD heading upwards, and it doesn't matter by how much. It can be just a hair, but just so long as it's moving up. So those are the signals that I use for buying a stock. Now, I haven't talked about shorting yet, but let's talk about it now. Shorting a stock is when you can identify a stock that's overbought and is ready for a pullback. You can use these same tools, but just in reverse. So let's look at a chart just as an example. Again, you're buying companies that are on the S&P 500. Look at that relative strength index, that RSI. Is it in overbought territory? Is it above 70 and coming below? That's your first signal. Then you're looking at the 50-day, 200-day moving averages. Is that 50-day average below the 200-day moving average? Then you're looking at the stochastic oscillator. Was it in overbought territory? Was it above 80 and coming down below 80? And then you want confirmation from the on-balance volume. Is it in a down tick or down trend? That's what you want to see. And lastly, the MACD, you want that black line coming down, and it doesn't matter by how much, just so long as it's coming down. Okay, so those are the signals when to buy, but there are other safeguards to keep in mind. And let's talk about those safeguards right now. Now you're ready to place your order to buy the stock, but do not use a basic market order. Always use a limit order. What's the difference? When you place a market order, and that's a very basic order, your order is filled at the prevailing price at that time. A limit order is the same thing as a market order, but up to a predetermined limit. Let me explain. We'll keep the math simple. Let's say you're following a stock, it closes, it's trading at $100. That's the closing price. You've done your research. Yeah, you want to buy the stock the next day. Don't place a market order, because let's say overnight there was some news. It was just fantastic news for whatever reason. And then right at the open, right at 9:30, the opening price was 110. Well, guess what? You get filled at 110. You don't get filled at 100, you get filled at 110. And if the stock should actually come down throughout the course of the day, maybe it closes at 105. Maybe you hadn't watched anything during the course of the day. You take a look at the closing price. Hey, it's 105. I'm up 5%. No, you were filled at 110 and it came down $5. You actually lost for that day. Now the math isn't exactly 5%, but it's close to that. So what you want to do is have a limit order. Now my goal is to achieve a 2% rate of return. So I'm going to have a limit of 1% before my order gets filled. So again, using the same example, $100, it closed the previous day. You do your research, you like it, but you put a limit order at 101. So if it opens right at 9:30 at 110, your order does not get filled. It's only going to get filled if the stock price is 101 or lower. This is very important because this can protect yourself, and this also enhances your returns as well. So Rule number 7, always, always, always use limit orders. Don't use market orders. Let's go to the next point. Rule number 8, how and when to sell. The last number of slides I've been telling you technical indicators and also some methods when and how to buy, but how and when do you sell? That's just as important, if not more so. Well, there are 2 things to remember when exiting your position. Are you trying to minimize your loss, or are you trying to maximize your gain? All right, so let's talk about minimizing your losses, pardon me. 2 ways you can do this as far as minimizing your losses are concerned. I was telling you that my favorite technical indicator is the stochastic oscillator. So let's assume for a second that you've met all the signals are telling you to buy, and you buy the stock. But maybe after day 3, it's starting to tank. It's going in the wrong direction. This will happen, not a matter of if, it's a matter of when. I was telling you that the stochastic oscillator has 2 lines. There's the black line, the primary line, and then there's the red line. It's the secondary line, which is really a 3-day average of the primary line. If that primary line goes in the opposite direction and intersects with that secondary red line, issue a sell order at the open the very next day. You want to minimize your loss. That stock is changing direction for whatever reason, we don't know, but minimize your losses, get out while you can. If it's a temporary thing, you can always re-enter your position a couple days later, but right now the signals are saying it ain't happening, so you want to get out. So that's one way of doing that as far as minimizing your loss is concerned. The second way to minimize your loss, and also you can use this to maximize your gain, is by using what's called a stop loss order. Okay? I told you right from the outset, I don't want to be a day trader. I don't want to be in front of a computer terminal 6, 7, 8 hours a day watching a stock constantly. But if a stock is tanking during the course of the day and I'm not watching it, I want to get out of that position. So the way to protect yourself is by using what's called a stop loss order. And it's a standing order throughout the day that if the stock should actually hit that particular price, it issues an order to sell. All right, so let's use an example again. We'll keep the math simple. Let's say you bought a stock at $100. I always have my threshold, an acceptable loss limit as 3%. If I'm going to try to gain 2% consistently, I can accept a 3% loss periodically, and I'm okay with that. So let's say, for instance, you buy a stock at $100 and it gets filled at $100. Right away, issue a stop loss order for $97. Okay? So you've issued your order, it's filled at $9.31. You go about your day, go read a book, go to the park, what have you. If that stock should happen to tank and drops down to 95 or 90 or 85 or something crazy like that, once it starts falling down to 97, you're out. Okay? So a stop loss can help minimize losses if there should be an unfortunate course of action during intraday trading. So that's one way of protecting yourself. So minimizing your losses, the stochastic oscillator, if those lines should intersect, we're using a stop loss order 3% below your original settlement price. Those are 2 ways of getting out of the trade. Now, let's talk about something positive. You bought a stock and it's soaring. It's going to the moon. It's fantastic. You want that to happen all the time, of course. But when do you get out? When is the right time to sell? Well, again, you want to use stop loss orders to maximize your gain and to ride the trend. Okay? How do you do that? Well, I've got a chart here. Take a look at this. Again, let's assume for a second you buy a stock at $100. So your goal is 102. So let's say after day 1, it closes at 102.50. Fantastic. You've met your goal. So that day, you issue a stop loss for $102. So the next day, if the stock should fall at 102 or lower, it's going to issue an order. You'll get out at 102. You've made your 2% profit. That's what you're trying to do. But what if that stock just continues to climb? You don't want to sell too soon, of course. You want to ride the wave. So let's say on day 2, The low during intraday trading, it only went down to 102.50. Great. Your stop loss was not filled. So you're going to be making more than your 2% rate of return. Revise your stop loss and change your stop loss so that it is 1 penny lower than the intraday low. So for day 2, the low price was 102.50. That night, revise your stop loss order to 102.49. So now we go to day 3. Again, the stock is still climbing. Its intraday low was only 103. It didn't go down to 102.49, so that order was not filled. Fantastic. Ride the wave. The intraday low after day 3 was 103. You change your stop loss that night to 102.99, 1 penny lower than the intraday low. Day number 4, the stock continues to climb, but the intraday low was 103.50, so your stop loss again was not filled. Fantastic. Revise your stop loss so that's 1 penny lower than the intraday low, so your stop loss now becomes 103.49. All good things come to an end. It's not a matter of if, it's a matter of when that stop loss is going to get triggered. So let's say the stop loss came down to 103.25. It fell below 103.49, but at 103.49, the stop loss order was triggered and you're out. And so let's say the stock sells at 103.49. Guess what? You've made a 3.49% rate of return just by using stop losses to maximize your gains. So that's how you do it. Okay? Now, we've talked about when to get in, when to get out of trades, and how to do that, but there's also some other points that you need to keep in mind, again, to mitigate risk. And let's talk about those right now. Rule number 9, diversify. You want to protect yourself as much as possible when you're doing this sort of venture. This is not a perfect system. I've never said that it was. It's not a matter of if, it's a matter of when. Losses can and will happen, and you want to protect yourself as much as possible. This is a percentage play over the long run. There will be more gains than losses. Nonetheless, you still want to minimize those losses as much as you can. Now, I've talked about different ways of mitigating risk. I was talking about the stochastic oscillator exiting early. I talked about stop losses to keep your losses to a minimum as well. But the key point to actually mitigating risk is by diversifying. And there's one basic rule, and that rule is simply this: do not put more than 10% of your portfolio on one stock. Let me say this again. Do not put more than 10% of your portfolio on one stock. So if you have a $100,000 portfolio, you are not putting more than $10,000 on one stock. So you want to significantly reduce your risk. This is a way of doing that. I talked about the stochastic oscillator and stop loss orders. Diversifying is the third point as far as mitigating risk. Okay, so I've talked about minimizing risk. Let's talk about enhancing those returns, and we'll talk about that right now. This is a solid program. The numbers speak for themselves. The back testing has shown this to be a very effective program. But how can you get even higher returns? Well, one way of doing that is by considering leverage. And what you're doing is that you're buying on margin. In essence, what you're doing is the financial institution where you're buying your stocks from, they're in essence giving you a loan. So, and usually it's a 3-to-1 ratio. So let's say, for instance, you're putting up $10,000 of your own money. They can make a $30,000 purchase for you. That extra $20,000 is a loan. You don't have to pay it back. You do when you actually sell. But it's called buying on margin, and it can certainly magnify your gains, which is fantastic. But there's a flip side to that coin. It will also magnify your losses. So if you are new to stock trading, I strongly suggest you do not do this right at the start. Don't do this at the start, okay? work the system, gain some confidence buying and selling, maybe even do some paper trades, just phony trades on your own, just to get the feel for it. And you want to gain confidence before you actually consider this. The naysayers will tell you not to do this, but in many respects they view the world as the glass being half empty. By using diversity and 3% stop losses, even using leverage, can keep the risk tolerances certainly in check. Let me give you an example, if we can put up this slide. Let's assume for a second that you have a $100,000 portfolio. And again, like I said in the previous slide, diversify. So let's say you use that 10% diversification factor. So that means you're not buying, you're only buying 10,000 on the one stock. Let's say for a second that you lose. We were wrong. And you also used your 3% stop loss. So you lost $300, but you bought it on margin, maybe a 3x factor. So your loss is magnified 3 times. So you didn't lose $300, you've lost $900. But $900 on your $100,000 portfolio, it's less than 1% of your portfolio. And losing 1% is certainly within risk tolerances. And it's certainly that risk-reward scenario. It can certainly be used. And as I said, you have to be smart about it, but gain experience, gain some confidence, use the diversification factor, use stop losses, and buying on margin can be a very, very effective tool to enhancing your returns. So there you have it. Thanks very much for watching. Those are my 10 steps. My goal, as I say all along, is to get 2% rate of return each week. And if I can do that week in and week out, I've got my 100% rate of return over the course of a year, virtually risk-free, by doing my swing trading method. Now, this system is not perfect. Losses will happen time to time, but this is a percentage play, and I've got the back testing to support this. Now, you can certainly do this on your own. Use these tools, follow each step to the letter, and you can do this on your own. Or I can do it for you. Go to my website, 2percentgold.com, sign up for the daily email. Each day, I will send you an email with stocks that are poised for a 2% gain within the course of a week, either going long or going short. I'll show you the limit price, where the target price should be, where your stop loss should be. Also, as part of the daily email, you'll see a running total where accumulation of all the picks that I've made that are still active and when they should be sold. So the email itself is free for the first 30 days. It's $49 per month thereafter, and you can cancel it at any time that you like. So that's it. I hope to be doing a weekly a weekly video like this. I call this the pick of the week. But what I want you to do, if you like this video, please click on the like and subscribe button. You'll be getting instant notifications for new videos that I do with the picks of the week. And that's pretty much it. My name is Al O'Grady, founder of 2percentgold.com. I hope you learned a few things, and good luck with your investments.